Thank you, Claudine, for that introduction. I was reminded recently I was at a Planned Giving Group conference meeting, monthly meeting in a city, and one of the speakers was being introduced, and it went on and on and on and on, and he got up and he said, you know, there are some speakers that need no introduction and some introductions that need no speakers. Anyway, thank you very much, Claudine. I'm really glad to be here and have you make the introduction. All right, what I want to do this afternoon is cover 9 trends, okay? But before I do, I want to set a little bit of background here. First of all, things are always changing, and that's going to be a constant theme of what I'm going to cover this afternoon. The trends that we're going to look at are the result of things that are going on, that are happening around us, changes that are ongoing, but they are subtly interacting in different ways. And so all you can really do at this point is take a snapshot of reality as it is now, but by 3 weeks from now, some of what I say will probably not be relevant. So I want to stay with things as much as possible that are broadly applicable, at least over the next 6 months to a year. All right, so understanding some of the changes that are there and some of the things that have always been there that are not changes is what I want to try to help with this afternoon. All right, what's driving the trends? Well, we have a lot of economic issues we're going to touch on this afternoon. Lots of issues there. We continue to have an aging of the U.S. population. Along with it, the donor base. We have some younger people coming on now that we didn't have 10, 15 years ago. Some of the baby boomers are starting to get a little older, but we're going to look at that aspect. And then at the end, I'm going to take a look at some issues related to tax policy. I was in Washington on Monday afternoon meeting with some people there who are active in trying to preserve the charitable deduction. And when we get to that point, some of you may not be following some of the latest proposals, but they are serious, and they may not be enacted as they are, but they are forming the blueprint and the groundwork for what Congress is going to pick up next year with the new Ways and Means chairman. And then we have some issues related to competition, which can be in some ways good and in some ways not so good. Oh, here's the same thing again. This is the first page of my presentation on trends in 2002. Same trends: political uncertainty, economic fluctuations, demographic shifts, tax changes, social change, more organizations. I decided to go ahead and say increased competition instead of more organizations, but it's the same thing. But wait, what is this? This is trends in Planned Giving Committee on Gift Annuities, March 9th, 1995 in San Francisco. Anybody here at that conference? Yeah, it was a dark room with it was black, dark, big ballroom dinner thing, slide projector. You know, I had to do slides and put them in the row, and you couldn't change the thing at the last minute. You had to do it in advance. Okay, so what were the trends then? The golden age of planned giving, the aging of America, changing political climate, changing family structures. Okay, at that point, we were starting to see increases in divorce rates and alternative lifestyles and other things that we predicted were going to have an effect in 15 to 20 years, and they have. Planned giving is now the fastest growing source of income. Greater interest among allied professionals, greater interest among regulators, greater emphasis on cost and benefits, more resources being directed to planned giving, greater involvement of financial professionals and regulators, and greater volatility in the financial markets. So this is almost 20 years ago. So again, the more things change, the more they stay the same. New ways of planning gifts, new uses for old plans, emergence of the blended gift. That's a term that's now come into common use. That was a term that we first used in a presentation in 1994 entitled "How Will the Baby Boomers Boom?" when they were in their 40s and looking forward, because they were so young, you were going to have a combination of current and deferred gifts, and we're there, and we'll talk about that. And then working with non-traditional market segments, again, younger people. I saw a 30-year-old, I heard of a 30-year-old recently who did a multi-million-dollar charitable remainder trust for their lifetime. Blended gift, right? Well, that sounds crazy. $150,000 a year and you're not going to get any money for like 50 years. Yeah, but if he says, I want 30% of that money to go for charitable use from the very beginning for the rest of my life, that's $50,000 the first year, and then on from there. That's what I refer to as a loony trust. It is a hybrid of a lead trust and a unit trust. It's a unit trust, but you carve out a lead trust interest, okay? That's the emergence of blended gifts and working with non-traditional segments. Again, nothing new about any of this. All right, we're going to look at 9 trends that are all interrelated, and my colleague John Jensen here is going to watch the time, so I am cognizant of the fact that we're going to try to actually stay on time here. All right, trend number 1, individual giving is still weak. All right, why do we care about this? Because we're operating in the context of overall fundraising efforts. You've seen a lot of hype and a lot of, I wouldn't say hype, I'd say news about how charitable giving is rising in record years and we're expecting 13%. When giving goes down 33%, how much does it have to rise to get back where it was? 50%. So it takes a long way to get back where you were, and we're not there yet. All right, we have not recovered to 2007 levels. This is individual giving. Most of the charts you see are total giving in America, including corporate, foundations, whatever. The foundation giving has driven, and corporate has come back in the last few years disproportionately to individual giving. All right, so what we need to look at, we work with individuals, and individual giving is still below 2007 levels. Now, if you adjust for inflation, for the spending rate of the spending ability with that money, we're below 2000 levels. Okay, we still are not at we still haven't recovered from 9/11 yet as far as individual giving. And the world changed that day, as many of you were around then, and it hasn't been the same for anything, including philanthropy, since 9/11, and we have yet really to get back to those levels. Now, some people are saying that it could be 2016 before full recovery in individual giving. I put this out there because there's a lot of pressure on people to make goals, and a lot of people are looking to plan gifts to, quote, fill that gap. But some of the things that people are using to put in the gap are not exactly, they're not exactly plastic wood that's going to harden up and fill that gap. Some of it's pretty soft. And guess what? When the economy does get fully back and giving comes fully back, we don't want people looking back and saying, oh, look at that. Our planned giving program ran amok in the last campaign. They're not going to blame the people who decided to count some of the things that are being counted now, because that's not going to, it's going to be real interesting. So we've got to, there are good things we can do to fill these gaps. So I want to look at some of the things that people are doing that may be less wise, and then we'll look at some things that might be better. All right, planned gift results are mixed. Okay, you all know about the Great American Wealth Transfer. We talked about that before. Announced in like 1998, trillions and trillions and trillions and billions and millions. And Frank Minton, and I remember a quote from an article in the Chronicle of Philanthropy about 7 years ago where he said, it's like these people are sitting on the beach drinking Mai Tais waiting for the wealth transfer to roll in, you know? And it's not, it just hasn't happened that way yet, okay? There hasn't been much growth in bequest, hardly at all, over the last decade. It's pretty flat. 2008 was a fluky year with had a couple of multi-billion-dollar estates in it, but it's been pretty flat overall for this last period of time. If you look at bequest income adjusted for inflation, it's actually below 2000 levels right now. So if you haven't exactly been blowing the doors off with bequest income lately, that you're not alone. However, remember, these are averages. These are everyone taken together. Results are not uniform, okay? Some organizations have grown in terms of dollars and numbers of estates. Here's one that went from 55 million to over 150 million during that period when everyone else was flat. Was this a lot of big gifts? No. It's volume, it's numbers, it's market share. Now, here's another one, same sort of growth, 45-degree angle. A little bit of a depression there in 9 and 10 and 11, but coming back. Here's another one. This is number of estates. This is the same one, but this is the number of estates. Again, being driven by volume. Some organizations, on the other hand, have seen declines in both bequest income, in this case, and numbers of estates going from the 70 range to the 40 range. Now, I'm going to tell you later on what caused this, at least what one of the main causes was. But the primary cause of this particular situation was a big change in marketing strategy that took place in 2004 and 5 and began to show a downward trend within 3 years. You're going to find out tomorrow if you attend Russell James' session, and you're going to find out later in this one, that most bequests come from people who die within 2, 3, 4 years of death. The ones, the operative wills, that's the one that counts, the final one. And if you stop influencing those, it doesn't take more than 2 or 3 years to start to see a downturn. And then once you realize it happened, it takes 3 or 4 or 5 years to turn it around, and then you've got this 7-year hole that shows up. And that's what, this one's going to take years to turn around. Oh, okay. The more things change again. This is from my 1994 presentation. There were some people that had done well between 83 and 94, and then some people that hadn't done so well. At any given time, the total production of bequests or any gifts in America are the sum total of everything that everybody is doing, okay? Some are doing better, some are doing worse. Okay. Only about 3% of people, some of you have heard me say this before, but I have to say this, 3% of people are successful at most endeavors. The rest of them are mediocre or don't do so well, okay? So do you think the 3% are doing the same things as the 97%? No. It takes nerve, though, to be part of the 3%, and you sometimes have to go against conventional wisdom. But in this case, this organization was doing the same thing then that they're doing now. The only difference is they've got 3 times the income now that they had then. And this one has been merged, and a lot of other things have happened in the meantime. All right, what are the reasons for these trends? Okay, I got a news flash for you. If nobody's dying, there aren't going to be any bequests, right? Okay, so what happened was we got this problem here. Because of the low birth rates in the late 20s and early 30s, which in 1994, we said, look, we're going to have some problems in 2008, 9, and 10, and you better be ready for it because we're going to have to go through a 15-year of what I can only describe as the valley of the shadow of no deaths, you know, or not enough deaths, okay? And that's what happened. And it would have been worse if it had not been for all the extension of life that took place during that period, because more of these people survived. This should have been a bigger dip than it was, but because of all of the medical care and other things that are going on, better lifestyles, and we'll look at that in a few minutes as to who actually is living longer than other people. But suffice it to say, the number of deaths has not really changed. Over the long haul, if you go back to 1990, the blue bars here are the deaths in America, and the red line are the number, is the amount of bequest income. So there is a fairly good correlation going there, but of course you don't have to be a rocket scientist to figure that out if deaths are flat. Okay, now, contemplate the fact that in 1986, there were 13 planned giving councils with 400 members in this country. Now there are thousands of people in this field, and we created a whole lot more supply of what we do at a time when the demand was flat in the sense of what was going to happen. This is not going to change for a while. We're only about 2/3 of the way through this. We've got 5 or 6 or 7 more years. It's going to be 2021, 22, 23 before the oldest baby boomers start to die at the earliest. So the upturn doesn't start for a while. Okay, other things, more competition. Some people on the micro level, some organizations that were big programs in the 70s and 80s when there weren't that many people, as new people came in, the established programs got affected more than the new ones. If you went from $100,000 to $200,000 in bequest income, that's a 100% increase. But that, given the fact that it was relatively flat numbers of the states, somebody didn't get that 100,000 that you got. So the pie was split. The pie wasn't really growing much, and it was being split by more ways, and the people who were already at the table before all the new pie slicers got there, they got smaller slices of the pie. Now, if you look at the growth from a new program, they may have grown during that period. It was very hard to grow as an established program during that particular time period. When you're talking about going from 20 million to 40 million or 30 to 60 or 50 to 100, hard to do in this level of competition. In some cases, there were just bad marketing decisions made. And I don't mean just in the planned gift area. I mean in some cases, people cut their acquisition of older donors. They did all kinds of things involving return on investment by cell analysis and things like that, was, oh, these people only gave $10 for their first gift. Well, we've got an algorithm that shows that if they don't make it to average gifts within 4 years, they never are, we'll get rid of them. But they didn't pay any attention to their age. One organization went from 18 million to 9 million because they threw away 475,000 new donors who we went back and put an age overlay on the ones that they threw away and found out like 85% of them were over 75 when they made the first gift. $5 is a lot of money to an 80-year-old. You know, bought a week's groceries in 1950. Okay, so that's just one example. Other people decided that print wasn't worth anything anymore and they went completely online too soon. Other people did other things. They thought they could outsource all their plan giving to other people. Lots of things people did in the marketing area. And then other people thought, oh, those 70-year-old donors, you can stick a fork in them. They're done. Right? Those bequest expectancies, let's go get some new ones. Now, this was done in the campaign world where people just going after more and more. Every campaign, they got to find a bunch of new bequest expectancies. So you have to believe that you don't need to spend any time with the ones you already have. Okay? And we'll talk about that in a few minutes. But the people that have done the stewardship have seen lots of success, and those who have decided you don't need to do it. I was going to put this later, but I do want to say this now. Again, when somebody puts you in a will, who's in the will? Who? Family members? Close friends? Who else? Charities, okay? So you're being elevated to the status of a family member, right? Same kind of, that's pretty, somebody's 75, 80 years old, and they've spent 60 years working, and they've accumulated a few $100,000, and they're sitting there deciding what they're going to do with it. Do you know how big a decision that is? You have no children and you want to decide where to reinvest all of the energy that you spent accumulating that money? And so they tell a charity they're in the will, or they call up a niece and nephew and say, I'm leaving you my money. What niece and nephew in their right mind would ignore that aunt for the rest of her life? Well, there are thousands and thousands and thousands of bequest expectancies being totally ignored out there, and many people in this room, I hope not very many, but some of you are probably being taken out of more wills than you're being put into because there's too much emphasis on getting new ones for metrics and whatever, and there's nothing wrong with that either. It's just don't forget the older ones. I've got an article in Case Currents this summer about this, about how a 65-year-old couple with a bequest expectancy, you're taking on a 25 to 30-year stewardship obligation. 25 to 30 years at 65, okay? Now, a lot of people, we're going to get through this cycle soon because a lot of universities don't have any younger people to go to. In the 90s, they got the low-hanging fruit off the ground. In the 2000s, they got the relatively low-hanging fruit. In the next campaigns that ended a few years ago, they went higher, okay? This next round of campaigns, there's no low-hanging fruit, there's no medium-hanging fruit. You're going to have an oxygen mask to go high enough to get the fruit. And then that's all that's there because it's a static donor base, okay? So again, we have to be careful what we do. We're not through when they say you're in their will. And I know everybody in this room understands that. But unfortunately, we work in situations, we've got to constantly be telling people this. And we have to sell that concept internally. All right, gift annuities, similar trends going on there. Almost everyone got impacted by the economic situation in 9 and 10 and 11. This is an organization who was doing somewhere around $2-3 million growing, then bam. But they're coming back in 11 and 12. This is the number of gift annuities they did during that period. 10 was a really bad year, even though interest rates were so low and people were so scared. Even though they were afraid of outliving their money and they needed that income, they just couldn't do it. 10 was just a bad year for everybody. Now, look at this one, though. This one went from an average of 500 annuities a year. This is a big, big annuity program. And look what's happened to it in the last several years. This is a disaster. Now, how did this happen? Because there was that some people who didn't think you could, they didn't understand how old the people were. They stopped their marketing entirely, did a few e-blasts here and there, nothing else. Nothing wrong with that. It's just that they ignored the people in their 70s and 80s, and the people running the direct marketing program wouldn't let them market to active donors. So at first they let them go to a few thousand people that had been lapsed for 4 years or longer. Go look at your bequest and annuity programs and look at the date of the will or the annuity and see how it relates to the last gift. If people have been lapsed more than 3 or 4 years, you're not going to get the gift. So anyway, it does matter what you do in this area. Now, some have done better. This is one that's done really well. Now, look at the whole, though, in 9 and 10, but it bounced back. Now, look at the number of annuities. Bouncing back, but not totally back yet. I think this one will get back to the same volume numbers of annuities in a few years. But look at the average size of the annuities. They're getting bigger. There's more how many of you who've been in this field for a while have seen more high five-figure, six-figure annuities than you did when you first started? You know, a lot of people raise their hands. When I first started in this field, there was only the annuities were like 5,000, 10,000, 20,000. You'd rarely see one for 100. Now 100's not that unusual, and 500's not that unusual. Someone was just telling me about a 500 one right before this session, and $1 million's not that unusual. We have clients that are setting maximum amounts for their annuities, right? Don't worry about a $5,000 or a $2,000 annuity is not going to take you down. A $5 million annuity, which is an open-ended debt obligation for who knows how long, that can affect your bond rating, okay? And that's the reason they set the maximum, because their bond underwriters made them, because they considered it a material debt with no way to say what it was. Okay. Another trend, we've talked about this, the grain of America. I'm going to run through this quickly because we've already touched on most of this. We have to go back to my old friend, the birth chart, which I've been using this chart for about 25 years, and we've been following the progress of different generations along the way. But for those of you who are new to this, there was a birth rate decline during the Depression and the early parts of World War II. This was caused by lots of factors: the economy, the urbanization of America, mechanization of farms, family planning. The American Birth Control League, now known as Planned Parenthood, was founded in 1917 or 18, I think. So lots of things were happening. Big farm families, you didn't have 10 people in a farm family anymore. They moved to the city. All that was going on. All right, mid to late 30s, we started a long upward trend in birth rates. And then about 1960, when the birth control pill came out and a lot of other things happened, the birth rates dropped again to the low point in 74. Then we started another baby boom. Why do we care about this? Well, that hole over here, this hole is what caused the flat deaths for the last 10 years. And it didn't really start up until 1944, which is how many years ago? 70? A 70-year-old still has a 12-year life expectancy, maybe 14, 15. So we're still got a period of time before we're going to see upward pressure. Now, you know what's going to happen? A lot of people are going to give up and leave the field, and those who stay are going to boom when the baby boom really happens. But a lot of people, a good part of the 97%, and their boards are going to decide, we've been flat too long, we're down too long, we're out of here. You know, we'll send a mailing every once in a while, and we'll throw a website up, but that's all we're going to have, and we don't. We're going to have to do some education here. All right, 75 million people in this country are turning 70 over the next 20 years, and nobody's coming behind them to pay taxes, to give, to do all sorts of things. Now, we can have immigration reform, and we can backfill the tax problem. We can brain drain the rest of the world and bring every educated person we can in here and give them jobs so they can pay our taxes and pay for the baby boomers' retirement. But you're not going to see a big boom in philanthropy from a lot of the immigration that's going to come in. It takes 2 or 3 generations generally. So we've got a baked-in issue here as far as philanthropy is concerned. All right, the greatest growth rate in the next few years is going to be in the 60 to 75 age range. actually declining in 45 to 55. A lot of people are having trouble getting younger donors. You know why? In their 40s and 50s? You know why? Because donors that weren't ever born are the hardest people to raise money from. Okay? So there you go. These are the people that are alive today. Okay? Now, look, that was 2010. Look at the alive rate in 2020, and look at the fact that there's actually going to be a decline. There's your decline starting in the 45 to 55 age range for people that are that are going to be that age then. But that red wave going over there, the oldest people in that wave in 2020 are just going to be 72 years old. So we've got to go through some stages here, and much as we might like to, we can't just skip right from current giving to bequests for some of the baby boomers. It's going to be more complicated than that. All right, it depends on the organization what impact this all has. This is an organization with over 1 million donors, and they have more donors 80 years old than any other age. All right, if you were buying stock, would you buy this charity looking forward? I would, because I know what this charity does, and it's an age-onset charity, and they're going to skyrocket in numbers of donors because their donor base looked like this 20 years ago. It was just another group of people, 65 to 95. They're going to do fine. Now, this is a nice, good mix that's following the trends pretty evenly. This is an environmental group that's doing very well with baby boomers. I might sell this one, because they're having trouble because of the structure of their fundraising and how much it costs and high monthly payments and whatever. When you get people that are retired with 1% and 2% rates of return on their money, a lot of times they start looking for alternatives to high monthly payments. And I'm not saying don't do sponsorship or monthly giving, you must do that. But be careful that you have a way to manage the downgrade and deacquisition process and let people out of those recognition societies, 5,000, 10,000, President's Club, Bluebirds, Redbirds, Castle Club, whatever you call it, okay? Make sure you have a way to let people out of those things as they age, because otherwise they're going to out themselves entirely and just stop giving, and every time you have a new president or a new football coach or a new CEO, you're going to lose a bunch of people, and they're going to use that as an excuse because their egos otherwise won't let them admit that they can't afford to do it anymore when a friend calls them. So make sure you anticipate the lapse, because managing the pre-lapse and early lapse and early post-lapse strategy is a lot of what's involved here. Okay, this one, I've never used this chart before. It's very interesting. This is the first organization I've seen that has attempted to acquire donors heavily in the millennials. You might as well forget the X generation, and this, as far as this organization, and if I told you who this organization was, you would think that the majority of their donors were in the 35 to 55 age range, and that's not where they are. Now, this is the first glimpse. I'm not going to have to deal with this problem, but there are people in this room that'll be sitting here in 25 years, and the speakers are going to be talking about how to deal with this next dip. So let's learn how to deal with the one we've just come out of and figure that out so that the people that come after us know what to do with that next hole, because it may be worse than the other one because they've got student loans out the wazoo and all other things competing with their giving. I'll come back to this one in a minute. Here's a large university. Look at the alumni they have, and look at the 75 line, and look at how many of their alumni. Planned giving has not been very important for this university. Planned giving hasn't been important for a lot of universities because they didn't have a lot of people over 75, 80 years old because of the world. They had smaller classes, but those post-war classes are now moving into their 70s and 80s, and if these people don't know how to follow that mountain of people into the second part of their life, a lot of these this has a good football team. But they're going to lose in this case if they leave the philanthropy field in the fourth quarter. And a lot of charities are leaving in the fourth quarter, and they're leaving it as open field to the people that are staying on the field from age 75 to 95. All right, here's something else that I would challenge those of you who are in higher education, especially, to go make this chart up for yourself. This is the same university, but look at their class participation rates, and look at age 60. See how that spikes up there? I've never seen a university where the class participation rates did not peak in the 65 to 85 age range. While all the energy is being spent over on the younger side acquiring these people. Okay, This is another of my 97% factor. You know, the people that are in the 3% they know this, and they're paying attention to where the money's really coming from. It's not all about, you got to look at class participation by age. The overall participation in this university here is around 18%, but everybody over 60, it's in the 25 to 40% range. Now, if we can maintain that as this group gets older, it's going to mean a lot of increased giving, a lot of planned gifts, annuities, everything in higher education. All right, lots of different impacts from the aging factor, just depends on who you are. Okay, the next trend is that economic conditions have probably, on paper, never been any more favorable than they are for planned gifts than they are right now. All right, stock markets recovered from the low points in 2009. Now, if you started investing in 1999, you may not feel that rich. You haven't done that well. But if you're 75 years old and you started investing 35 years ago, if you put $1 million in a Dow index fund in 1981, you have $16 million if you just left it alone in an index fund. It didn't do anything else. Now, a lot of the people that we're dealing with, the 1% who have all the wealth in this country, a lot of them are people that benefited from Benjamin Franklin's miracle of compound interest. They just left the money and let it sit there and grow, and this doesn't account for compounding all the dividends. If you reinvested your dividends, it's even more than this. This is just Dow closings at the end of the year. Now, if you look at the market, though, has actually, since the low point in 2009, in March of 2009, from that point, the market is now up 150%. Now, this cuts both ways. People who were younger and decided, okay, this is my chance, and they just bought into that market, they did really well. But people who were 75 years old and freaked out and got out of the market, they took the loss and they never got back in. They just couldn't do it. They couldn't take the risk. We've already had a wealth transfer. We've had a wealth transfer from the older people that sold out of this market to the younger people that dollar averaged into it. And we've already transferred a lot of money from what used to be belonging to 70-year-olds in 2008 and now belongs to 40-year-olds. The money's already transferred, but it didn't happen through estates. It's a different way. We did it differently this generation. The baby boomers, their parents inflated away their parents' life savings in the 70s and 80s to pay for the Vietnam War and the Great Society. That's when a $3,000 Chevrolet became a $15,000 Chevrolet, right? But older people on fixed incomes, they just watch their, we need to understand this because a lot of people, really wealthy seniors, they got it back. But there's a group of people in there that had enough money, but they had to get out and they didn't have the I don't know what the right word is, confidence to get back in. Okay, by the way, anybody here dealt with any older donors that this happened to? Yeah, I mean, it's not that uncommon. All right, interest rates. Look at Treasury rates from 1981 to the present. We all know they've been going down, but they've gone from way up at 14%. In 1981, $1 million in treasuries would give you $140,000 in 1981 money when you could buy a car for half the price it is now. Today, you get around $10,000, $12,000 on $1 million worth of treasuries, so that doesn't look so good. Now, you compare the decline in treasuries to the stock market, and there's an inverse relationship there that many of you are already aware of that. But let's go back a little further. It took about 20 years to go from 3% to 14%. In the early 60s, when we started inflating the economy and spending more money than we were taking in and having inflationary pressures during that period, it drove the interest rates up. At the same time, the Treasury rates from 62 to 81 quadrupled. Now look at the Dow for that period, look at the increasing interest rates, and look what happened to the Dow, inflation-adjusted Dow during the same period. So I'm showing you this because there are people out there that are concerned that we may actually be starting into a period of higher interest rates, and that will affect the value of investments because people, if you can get 5 or 6% on treasuries and safe investments, quote unquote, you will shift more out of equities and then you have selling pressures. So we've got a really mixed bag here. Housing values have come back I saw a chart the other day that showed the inflation bubble and inflation-adjusted housing prices. The average home in America in 1970 was $25,000. It got up to $250,000 at the bubble. It's now back to around $150,000, something like that, which is the inflation-adjusted. So the good news is the housing market may be okay now, and I think people have seen the worst of it, and many people have seen prices that have risen. Some people think they're still going to get a lot of money in appreciation on their houses, but who knows? All right, so there's a good supply of, quote, raw material out there for plan gifts. Low returns seem to open up all these opportunities. Hey, look at that. People are earning 1 or 2% on their money. Why aren't they doing gift annuities in huge numbers? Well, I'm going to show you in a minute why they're not. Okay, many seniors, though, are concerned that they're not going to have enough money, even though everything else is done well. All right, what does all this mean? Confidence is good on Wall Street, but Main Street may be still a little skittish. I won't ask for a show of hands as how many people in this room are feeling real financially secure right now, but it's probably not as many people as if I was talking to a group of Wall Street investment managers, okay? We've got two Americas here. Older people, because they didn't necessarily recover from that. There was a woman who had made $1 million pledge to a campaign. Market crash happens, husband dies, development director or CEO goes to her and says, we understand in this environment if you can't afford to if you decide you want to delay making this particular gift. And she said, no, I'll do it, but I want to do it anonymously. I don't want anything named after me and George. Well, why is that? Well, I did well, and George got out of the market in time, and we preserved all our money. In fact, I've got twice the money that I had in 2007 or 8. I've done very well. But I have many friends who are having to move out of the retirement centers where they are because they lost a lot of money and they can't afford it anymore. And I don't want to seem, she said, for me to do $1 million gift publicly right now and take credit for it would be, she used the words untoward and gauche. So you're going to see a move towards more anonymous giving in the next round of campaigns among older people for lots of reasons. I read an article once with 13 reasons people give anonymously. And it's all kinds of things. They don't want to be developed. They don't want to be, they sit on boards. You know, when you tell your boards about how you've done these enhancements and you've gotten all this information about all these donors, they know you're doing it on them too, right? And they know that people are going around taking pictures of donor walls and then they're sending them overseas and people are typing in the names and how much money they gave. You posting your bequest societies online? The people online, because you don't print them anymore? Guess what? There are people out there that are combing the internet looking for all of those listings, and they're compiling all those names, and they're selling lists of people that are known to be bequest donors that are already in somebody else's bequest society. So I knew one organization that had thousands of names up there until they realized that, and they took them down in a heartbeat, because they can go against your file and find exactly the people that have already notified it's the other people's best bequest expectancies. Okay, the financial community has already adapted to this. Okay, how many of you most of you don't watch television on weekday mornings, do you? Well, a lot of your donors are. They're watching CNBC, and they're seeing something like this about every 15 to 20 minutes. Well, you know what this is an ad for? A reverse mortgage. Fred Thompson and, who is this guy? Tommy Lee. Okay, Tommy Lee and Fred Thompson, they're your biggest competition. That's who's going to put a dent in the residuary estates. That's who's getting your annuity money in many cases. Because they're basically just people are buying an annuity, a commercial annuity with their home. They call it a reverse mortgage, but all it is an installment, open-ended installment sale. It basically pays a certain amount every month until the people die, and then they come in and take what's left of the house. Well, they take the house. Okay, so all these factors, we got slow recovery and outright giving, record amounts of wealth, low returns on investments, an aging donor base. Why wouldn't we have the brightest future? We just need to go out and really just sell this stuff, right? Market, market, market. It's ours. We should be able to go out and get all kinds of gifts that we never thought we could before. All right. One of the trends, though, that I'm seeing is a big divergence in marketing and the way people are marketing plan gifts. Now, I'm not saying there's any right or wrong way to do this, but what I am going to tell you, if you go too far in some directions, you may be in for some very serious, problems. And so this is going to be a negative part of the presentation. So those of you who might want to check your email or something during this part, this is not going to be happy stuff. Okay, are we marketing plans or are we marketing gifts? Are we out there selling plans and looking for gifts to cram into our plans, or are we marketing gifts and finding people who finding the right plan to function that gift? These are two diametrically opposed concepts. Most people are still encouraging gifts as part of the natural life cycle, looking for people who have the donative intent, who really do want, how many people in this room support one or more charities? How many of you have ever wanted to give more to a particular charity than the gift you finally ended up making? Okay, how many of you believe you have donors who want to give more than they're giving? Okay, if you didn't raise your hands, you just ought to leave, because the point is, no, seriously, because our goal, we have got to find the people whose older people in many cases or younger people whose real or perceived capability to make a gift outstrips their donative intent. Now, with younger people in their 30s and 40s, many of them volunteer and do things because they have donative intent far beyond what they can do. Same thing on the older people. It's just at a different stage of the life cycle. So we're helping people do things here that they might not otherwise think they can be able to do. That's one way to, quote, market plan gifts, to talk to those kinds of people. And again, understand that the bequest means you're part of the family. And nobody in this room would dream of ignoring, as part of their marketing, ignoring the aunt or uncle who called up and said, "You're in my will." You would call and take them to lunch, you do a few things, and if you ignore them, the outcome is predictable. Others are comparing planned gifts to investments. Now, this is very tricky, because in one sense, if you say a gift annuity pays more interest than a CD, which I've seen in print, that's bad, because it's not just wrong, it's illegal, and it violates laws that we'll look at in a minute that many of you may not be aware of, okay? But you can say to a person, if you're in their will, and you say, if you're planning on doing something philanthropic as part of your long-range plans, and you would like to increase your spendable income from the money that would be ultimately go as a bequest, you might be interested in our life income gift, okay? I'm going to come back to that in a minute. All right, I don't think it's a wise practice to go too far. We may be inviting another trend here and some more regulation that we don't need. All right, what am I talking about here? When I'm through here, I hope none of you will feel comfortable ever again comparing a gift annuity to any sort of investment other than a particular kind. All right, fixed payments can be attractive. Very true. Annuity payments are good, very good. They offer a lot of opportunity for additional income, and there's no reason. It's okay to market these things and say you can get additional income from an annuity. But don't use income as an adjective. Use it as a noun, because you're talking about income, not income from an annuity, and not return from an annuity, and not the rate of return on an annuity. That's not an investment. It's not the same thing. With other things, you get your money back if you want it. With the gift annuity, you don't. There are tax benefits, but they're the icing on the cake. All right, can we really compare gift annuity rates to stocks and CDs? Should we use the after-tax cost of the gift to bump the yield? Yes, that's okay sometimes, because the fact is you do get a manufacturer's rebate on your annuity in the form of tax savings. So if you give $100,000 for an annuity and you save $15,000 in taxes, then it's okay to point out to people that you have to compare what you're getting to your net cost. So you compare the rate to what. There's nothing wrong with that as far as that goes, and there's nothing wrong with telling people that you would have to earn X amount of dollars pre-tax to get this money, okay? And I'm going to show you an example of that in a minute. There's nothing wrong with that per se. It's then if you go one or two steps further and you start naming particular kinds, saying you would have to earn this amount of money is one thing. Saying that we get it from, you can get it here instead of this, that's a different thing. And the people who market this over here, they're not going to like it, and they're the ones that are going to cause the problems when they see charities out unfairly comparing annuities against other investments. Okay, just tell you, there's no way to come out ahead doing charitable gifts. Every year with taxable estates, year in, year out, about 20% of people with wealthy people leave money to charity. The other 80% don't. And they know, because I don't care if there's a 100% deduction from an estate, it costs your family 60 cents for every dollar you leave to charity, okay? Who gives $1 million to charity to save $400,000 in taxes and penalize their family? Well, 80% of people don't. And 20% of the people, to do an annuity, you have to have the same level of donative intent that you have to do a bequest. So you're better off marketing bequest, and then the person who says, I would consider putting you in my will, talk to those people and say, well, if you have that level of donative intent, let me tell you about something better, or what might be better. Well, I'd like to give more now, but my CDs. Well, let me tell you how you could take that money that you're going to leave a bequest and maybe use it in a way, but you have to. That's a certain way of communicating with people. Okay, here's an 80-year-old woman in a gift annuity for $25,000, 6.8% payment rate, charitable deduction of $12,270. Okay, this pays 6.8%. She gets her tax deduction. Let me go back here. She gets her tax deduction. She saves $4,000, and you'd have to earn 10.4% to get the equivalent. Nothing wrong with that as it's stated, okay? Nothing wrong with that. But where is she going to go to get the 10.4%? It's a true statement, but what are you going to compare that to? If you just stop at that point and don't say, so if you're only getting 1% on your CDs, you might want to consider this, or if you're only getting 2% on your bonds, you might want to consider this. You're going to compare it to CDs, government bonds? Look at, well, show them this chart right here and then say, look, we give you a lot more for your annuity. Okay, or you're going to compare it to stock dividends, which are now down around 2% again. You see, when the market went from 13 to 16,000, the yield went from 3.5 back down. The 75-year historic yield on the Dow is around 3.5, 3.7%. And I'm not buying any more stocks until the Dow is yielding 3.75, which is around 11,000, 12,000. That's when you've got the right yield. And then if interest rates go up, you have to discount it more. But you don't compare against this, okay? Now, what investment is the only valid comparison? What do charities compare your annuity? What do you compare your annuities to when you reinsure? Where do you go to reinsure? What are you buying? What are you buying? How many people reinsure annuities occasionally? Okay, handful of you. All right, when you go to reinsure an annuity, you go to an insurance company, and they're saying, look, this person gave us $50,000 to pay them this amount of money. How much will you charge us to pay them the same amount? All right, we're going to look at that. Okay, commercial annuities are really the only valid comparison for a gift annuity. That's the only apples and apples comparison there are. And as you're going to see, there aren't really any apples to apples comparisons, hardly. I'll tell you why in a minute. All right, how many of you have donors who belong to AARP? Okay? Now, how many of you think they get magazines from AARP every month? Or go on their website or get e-blasts from them about, look, up until a few years ago, most insurance companies didn't market fixed payment annuities. Why? Because they made a lot more money on variable payments. There was a lot more commissions in that because there was a lot more equities in there. There were a lot more points to chip on equities than there are primarily on debt obligations, right? The commissions are much lower. Okay, so now you go to the AARP site and a person looks up an annuity for an 80-year-old. Now look at the payment rate, $322 on $50,000. That translates into 7.8% on that annuity. But you see the term there, cash refund? What does a cash refund annuity mean? That means that if the donor purchases a commercial annuity for $25,000 and only gets 1 year of payments at 7.8% at 1932 and passes away at 81, the heirs receive a lump sum refund. Any amount that hasn't been received, they get it back. You can't compete against that with a lower rate than that pays. Okay, now we're not through with this though, because you've got another one, another kind of annuity, a 10-year guarantee example. It pays $364. That's even more. That's 8.7%. But I want to show you something else. You see that $739? If you do $50,000, you get $364. If you do $100,000, you get $739, which is more than twice as much. And if you do $250,000, the bigger your annuity, the more they pay you because they're passing on the economies and savings of it. We can't do that. We pay the same rates in charitable annuities regardless of how much the annuity is. On the commercial annuities, you get the bigger the annuity, they pass on some of the, they don't load you up with as much of their overhead. Okay, what's a 10-year guarantee annuity? Donor purchases it for $25,000. She gets 1 year of payments of $21.84 and passes away at age 81. The heirs, whoever she names, gets the payments for 9 more years. Okay? Now, here's an opportunity for charitable gifts, though. You can ask people if they have commercial annuities with guaranteed payment options to name you to receive the installment lump sum or the additional payments. And I've seen charities that are starting to get those kind of gifts, where someone had a big annuity with an insurance company and it had an installment refund. The person died before getting all their money back, and they'd gotten $73,000, so it's a $23,000 bequest. So again, you can't win competing against these things. Even when you take the $20,000 after-tax cost, that's the 8.7% rate is even higher there, okay? Now here's the other problem. To get the 33% bracket that people use sometimes to illustrate these things, an 80-year-old would have to have $186,000 in income. Query, what does a person 80 years old with $186,000 worth of income need with a $25,000 annuity in the first place? Okay, the income is $226,000 for married people. All right, the truth is that commercial annuity rates are higher than CGA rates. Even more of the money's coming back as a return of principal. You know why? Because we're trying to get a 50% profit on the annuity, and the insurance companies will take a much lower profit rating level than we will. So the rates are higher because they're giving more of the investment of the contract back, so even more that comes back tax-free. So you can't win on that argument either. Plus they offer continued payments or refunds. The point is, just don't, what you say is, thank you for telling us we're in your will. Oh yes, and I would love to give more now, but I can't. Well, you know what? There's a lot of things you might consider. In fact, there are annuities that you can do with insurance companies that would pay you a lot more money. But you know, we have something similar where you want your money to come to us when you pass away. Well, we can pay you a nice additional income on our annuity. It won't be as much as you get from an insurance company, but it's more in keeping with what you're trying to do. Now, you will prevail with that argument faster than you will trying to beat the son-in-law. How many of you have donors who have somebody in their family that's in the insurance business? Why, look at this, George, son-in-law. This says I can get 6.8% and I'm only getting 2% of my CDs. I'm going to do this. Mama, I can get you 9% on another annuity. Well, right here it says 6 point. No, Mama, that's a gift thing. If you just want more income, we can get it over here. Now the 80% who die and don't leave money to charity, that's 80% of those people are going to go with the higher commercial rate because they're not have the donative intent. Back in the early 80s when I started doing this, John Tidd and I would do these seminars, and gift annuities were a historical footnote. We talked about them for 5 minutes in a 3-day seminar. Nobody did them. Why would you do an annuity when there was 14% interest rates out there and annuities were paying 8%? You know how you sold annuities at that point or convinced people that they might want to do them? You told them, well, we know you can get 14% on a money market and we can only pay you 7%, but your gift is giving up the 7%, right? And it worked in religious organizations and others. The same argument will work when you're comparing against a commercial annuity, but it's a training issue. Okay, now you want to see that straight apples to apples comparison, and why? Do you know how much trouble it took me? Mutual of Omaha was the only company that would give me this quote that I could find. And there were a lot of people go for reinsurance, okay? Now, here's what this is. This is an illustrated quote for a $50,000 gift. They're going to pay $3,400, okay? But you know what this is a winner-take-all annuity, which insurance companies don't even market these things because people won't go to an insurance company with the risk that they die the next year, all the money's gone. Charities can do that because it's only if the people have donative intent for a bequest. Okay, the rate on this one, the rate on this one is 9.5%, 9.46, and it's 9.75 with no commissions. That's why you can take a $50,000 annuity and pay Mutual of Omaha $35,000 and pocket 14, which is 28% of the gift amount. That's how reinsurance works. It takes the donors are overpaying for the amount of the annuity they're getting. So you go back in the commercial market and you reinsure it for the fair market value of the annuity and take the difference. Okay, look at these rates. The pre-tax is 6.8, after-tax 8.1. The 8.1 is fairly competitive, right? But it's a winner-take-all annuity. So you can't compete against the straight 9.5, even after tax, and you can't compete against the 10-year payment annuity. The point here is just be careful. All right, what's the risk here? How many people here issue gift annuities? Everybody? How many of you send disclosure statements out? How many of you think that disclosure statement is required by the IRS? Who requires that disclosure statement? The SEC requires it because your gift annuities are technically securities under federal law and they're exempt from registration under 3 conditions. The staff position since 1972 or since 74, I'm sorry, with pooled income funds is 74, it's 1980 on annuities. University of Minnesota went in for a ruling and wanted to know whether the SEC considered the gift annuities to be securities, and they said no, because it's regulated as insurance. But pooled income funds were. In 1995, they decided that gift annuities were in fact securities, and the conditions that you not have to have a license to sell them was that they primarily be marketed as a gift and not an investment, and that they could only be marketed by people who were volunteers or people regularly employed by the charity. No partisan compensation was based on the number or amount of annuities, no commissions. And 3, full and fair disclosure and explanation of the gift to each donor and prospective donor. Prospective means marketing to non-annuitants. You can't lie to people in your marketing and clean it up with a disclosure statement. That is a well-defined securities law concept. It's called fraud in the inducement, okay? So gift annuities are regulated by the SEC. Just Google up disclosure statement, Google up philanthropy and gift annuities, and this is what you'll get. You'll see all kinds of stuff, securities regulation of fundraising, all about the Philanthropy Protection Act. Some of you may want to go read some of this stuff if you're not familiar with the history of the Texas. How many of you remember the Texas lawsuit? About half of you, right? Cost the American Council on Gift Annuities about $1 million, I don't even know how much. A lot of money. Lindsay, is you here? How much money did that cost? I don't know. It's a lot of money. Took many, many years to pay off the legal fees because there was a class action suit for $1 billion and it named every charity that was a sponsor of the ACGA, and a lot of big charities chipped in a lot of money to pay a lot of legal fees. And finally, we had to get the Securities Exchange Act and the Sherman antitrust laws had to be changed by Congress to keep from losing that lawsuit, because it was a price fixing and a fraudulent security marketing charge, and the charities were going to lose because they had in fact misrepresented the gifts. All right, anti-fraud provisions apply. Federal courts don't look kindly on comparing these things to investments. This is some people that were going to jail for securities fraud, and they made an appeal saying we weren't really selling investments here, these were gifts. And this is the Ninth Circuit opinion. Our review of the record in this case demonstrates that the foundation marketed its gift annuities as investments and not merely as vehicles for philanthropy. One promotional brochure entitled Maximizer Gift Annuity, Maximizer Gift Annuity, a gift that offers lifetime income and beyond, states under the heading Attractive Returns. Number one, the word return is a no-no. That your annuity payment is determined by your age and amount you deposit. True. The older you are, the more you'll receive. True. The brochure goes on to list the current average net yield rates. Elsewhere, under a heading entitled A Gift That Gives to the Donor, to get this same return through the stock market, the hypothetical investor would have to find investments that pay dividends of 19.3%. Even the most profitable companies rarely pay dividends of more than 5%. The rate of return on a Mid-America Foundation gift annuity is hard to beat, exclamation point. And they went on to send these people to prison for securities fraud because they created this foundation and issued all these annuities and then gambled in Las Vegas and spent it all. Okay, you do not want to be the poster child when they come in and decide to make an example. That's how the SEC works. They don't prosecute everybody. Now, the real problem is not the SEC. It's a derivative, it's possibility of an action under anti-fraud, which might be brought by a third party. This is from Senator Dodd, who sponsored the Philanthropy Protection Act, who was helping to get the charities out of the mess they were in. We had to accept some more regulation in '95 in order to keep what we had, right? But Dodd said, okay, it also codifies certain exemptions that the SEC has recognized for charitable organizations that pool and invest donations. However, none of these changes would make it easier for charities to commit fraud. The legislation would not change the anti-fraud provisions in federal securities laws or affect federal tax laws related to fraud. People could still bring appropriate lawsuits against cheats or swindlers attempting to disguise themselves as charities or charities acting fraudulently. Okay? So, again, be careful, and be careful too much comparison to the after-tax yield, because the Congress is looking for abuses of the current tax laws, as we'll look at in a few minutes too. What's the better comparison? We've already talked about this. You're better to compare these gifts against other types of, against bequests. It's just another way to make a testamentary gift that gives you some benefits during lifetime. That's what a gift annuity and all these other things are. All right, some people are marketing deferred gift annuities to 55-year-olds as retirement plan supplements. That's okay if you want to manage money for 35 years, no problem. And if you can get people to take a current rate of 4%, if they defer it to 6.5, then you don't have to make any payments for 10 years, but then you have to pay them for. Nothing wrong with this particular gift. Tax deduction's 36%. But a lot of 55-year-olds are concerned about locking in something at that rate at this point, because the 55-year-olds remember when they paid 13% mortgage rates, and they remember when they could get 10, 12, 13% on savings. And a lot of baby boomers now believe that we may go through another round of inflation and higher interest rates, and they don't want to necessarily lock in their money at 55 for a life expectancy of 29 years. All right, let's say you've got a 70-year-old woman who says, I'm leaving you $100,000, and you thank her for her generosity, and you say, thank you so much, this is a wonderful gift. Her estate is $3 million, she tells you. She's alone, no children, no anticipated estate tax. The gift annuity would be 5.5%. So you say, well, maybe you might want to go ahead and do an annuity now for 5.5% and get a $42,000 tax deduction. And she says, well, I don't need any more income right now. I've got a $100,000 mandatory withdrawal that I'm taking from my IRA, which is more than I need to live on. I'm trying to reduce my income some way. I wish they'd bring that rollover thing back, and then I could give you some money, okay? But why is it, okay, I want an answer to this. Why is it that a 70-year-old woman with $3 million and all the money in the world to spend right now, why doesn't she just give you the money right now? What's she worried about? Later on, right? Is she worried about running out of money next year? No. About what age do you think she's worried about running out of money? 80. Do I hear 85? Going once. Do I hear 90? Okay. Okay, 95. Well, let's just say that she funds $100,000 deferred gift annuity, deferred to age 85. The rate at 85 is 12.2%. Her income tax deduction today is $78,000. My brother, who worked as major gift person for a national charity, he had this woman that was making like these $100,000 gift annuities, and she was like 90 years old, and she was deferring to age 100. She said, why are you doing that? Well, I like the fact that I don't really want you to get the money till I'm dead. But you know what? I figured out that I can get she basically was getting a $92,000 tax deduction for a $100,000 bequest. She didn't plan to live to be 100. Okay, this woman, in effect, with no taxable estate, she's going to get, if she dies next year, she's got an $80,000 tax deduction for a $100,000 bequest that's going to save nothing. Her life expectancy is still 22 years. Okay, she could do a flexible deferred annuity if she was willing to give up some of the current income tax deduction to start it a little bit sooner if she wanted to. That's a case by case. All right, look at this. She gets immediate tax savings. She gets an immediate deduction that will save her $10,000, $15,000, $20,000 in taxes. She continues tax-free buildup inside your annuity account for 15 years. The income is 12.2% if she's alive, but she's getting a current tax deduction for what is essentially a bequest. One of the trends that I think we're going to see is marketing deferred gift annuities to older and older people as people live longer. All right, what if she passes away at age 80? If you earn 4.25%, her balance there is $131,000, okay? So you don't get a $100,000 bequest, you've now got $131,000, and it's not subject to Fred Thompson taking the money, okay? They're probably going to sue me before it's over with. Okay, the balance at age 85 would be $150,000. Let's say you're going to have $150,000. You got to pay her $12,200, but it's not 12.2% on 100. It's 12.2% on 150, which is 8.1% of the balance at that point in time. Okay, now she lives 7 years. Do the math. You pay her 8.1 and earn 4.2. There'll be $100,000 there when she dies at age 92. What other, quote, deferred gift can you count at face value and not have to discount for any residuum? You're going to get the whole residuum because she gave you not only the money, she gave you the tax-free build-up for 15 years or whatever time it is before she dies. Okay, this segues into estate tax laws. The fact you can take the fact that the estate tax is no longer there and turn it around. Old George Carlin, is the glass half empty or half full? Neither. According to George Carlin, may he rest in peace, the glass is just too big. Okay? So, it just depends on how you look at it. If you say the estate tax is gone away, so there's no benefits for, you can say, now that you no longer have to pay tax on the amount going to your family, you already had us in your will, so now you can increase the amount of your bequest and the family will still get more. If you were going to leave $1 million and the family out of 10, and you were going to pay 3 in taxes and the family was going to get 6, you take it up to 2 million and the family gets 8. So you can say you can double your bequest and the family will still get more money than they would have before. What's wrong with that? It's the same thing here. You use the lack of estate taxes as a foil against which to show them something better. Which gets back to the fact that estate taxes are less important. Okay. We all know this. Threshold's $5 million, adjusted for inflation, 5.34, 10.68 million. But it also applies to gift taxes, and I haven't seen enough attention paid to gift taxes. We have to look at that a little bit. For those of you who've been in this field, first of all, we have to show what that exemption means. All right, there were 2.5 million people who died in 2012. According to the IRS figures that just came out, 8,400 had estates over 5 million. 99.7% of people died without owing any estate tax. Now, you see the blue part? That's the whole pie. Now, there's the non-taxable estates. There's the taxable estates. What looks like a little needle in the haystack, so I put a little thread on it for you, because some of you are going to have to find that needle in that haystack and sew with it, okay? Because a whole lot of the money, like a third of the money, comes from that little sliver. Year in, year out, the larger bequests in many programs account for a big part of it, 20, 30, 40%. All right, but we're looking at a small number of people. Query, is it a good idea to go tell your whole marketplace that they should give you money to avoid estate taxes? Now, there are some state taxes in a few states, 25, 30 states, but they're not anywhere near enough to compare with what the federal is. All right, out of the 8,400 people with the state's 2,200 left charitable bequests. That's 26% of the people with taxable estates. Now, the more people have in their estates when they die, the more likely they are to leave money to charity, because the more discretionary capital they have in the estate. It used to be 20% overall. The new number is probably going to be 26 because we're only dealing with people at $5 million and up. But about half, if you're dealing with people with $5 million or more, you can pretty much be assured that about 25% of those people overall are going to leave something to some charities. Okay, so that means that if 6% of the people who died, and again, this gets into some of the numbers that we see bandied around, anywhere from 5 to 8%. I just took 6 in the middle. That's 150,000 charitable estates in this country. If there's 4 charities named in each estate, that's around 600,000 charities, and if you get 35,000 each, that's $24 billion, and that's where the number comes from. All right, about 2,200 of those were taxable, as we just saw. 98.5% of bequests in terms of numbers are coming from non-taxable estates. There's your taxable, non-taxable bequest. There's your taxable bequest, okay? So again, I'm not saying don't talk to donors about estate tax avoidance, but be careful, because a lot of people aren't subject to it. Where does that fit in? Is there a risk of overemphasis? Can you overstate the tax consequences of a gift, and can that be misrepresentation and mismarketing? I don't know. But does zero tax planning make any sense when close to 0 people are paying estate taxes? I would ask that question. Now again, what does the son-in-law say? Well, son, look at this. I'm going to give all this money to charity to avoid estate taxes. Mama, you don't owe any estate taxes. You've only got $1 million or $980,000, and you wouldn't have to pay any taxes till you get to $5 million. Well, why do they tell me this? Now you got 2 choices that you got to make, what she can make. She can either think one of 2 things. What's the first thing she can think? That you lied. What's the other one? That you didn't know. So starting out with a donor having to choose whether you're dishonest or ignorant is not a basis on which to form a relationship. All right. Using planned gifts to provide for gifts other than other. How many of you seen a situation in the past where somebody wanted to do a big gift annuity for somebody else, or a charitable remainder trust for a brother or sister, and they were wealthy and they stopped? Why? Because they didn't want to do what? They had exhausted all of their exemption from estate tax at $675,000 or $1 million, and so $1 million CRT for a mother with a $400,000 deduction, that's a $600,000 gift, and they would have owed $300,000 in taxes, and the money's all in the trust. Nobody's going to do that. Okay, assume somebody does $1 million CRT annuity trust for an 85-year-old mother. We'll come by to Wyatt's annuity trust in a minute. Funded by a 60-year-old child. The payment rate is set at 7.8%, same as the CGA. The deduction is $566,000. The taxable gift is $434,000. This gift absorbs less than 10% of the lifetime gift exemption of 5-point-whatever million. It used to be, so this is not only doesn't give rise to any taxes, they've still got 90% of their deductions left, of their exemption left. As recently as 2010, that would have eaten up 43% of the exemption, and most people had already used their exemption. Now, why did I use a CRAT here? Why do you think a person with $1 million gift like this, what's the reason they might choose the CRAT, even though the annuity might look better on paper? The answer starts with an A, and the second letter is D. Anybody want to guess? Wheel of Fortune. Wheel of Misfortune. Advisors. $1 million coming out of somebody's portfolio is going to cost somebody a tuition payment. So they're going to argue for the annuity trust, and don't fight it, because you can't win that. Don't go in there and talk about exclusion ratios and stuff like that. They don't get it. They won't care. Why would people choose $1 million annuity over a CRAT? Well, you got to look at the treatment of the income and the exclusion of income, and the tax deductions are the same, but you don't want to get in an argument with the advisors over, we're going to take that $1 million out of that portfolio, and here's why. Well, unless you've got a real strong-willed donor, or you've got a very good relationship, I'd be careful with that. All right, you can also use planned gifts now because of this gift tax exemption to structure gifts that tend to transfer assets. Recall the $1 million exemption, all right? Let's take a 65-year-old donor who's a lead donor candidate to a campaign. They turn you down on a $5 million gift because they say they got to take care of their children. Okay, so what do you say? What if there's a way you could do both of those things? So they fund an $8 million lead annuity trust that pays 6.25% for 10 years. That's a $500,000 a year gift to the charity, $5 million in gifts over the term of the trust. Now, the gift tax deduction here, you're not trying to zero it out. You get a 4.4, you'd have to go 17, 18 years, maybe 20 to zero that out. There's a taxable gift there of $3.6 million. But the parents haven't used the 10.68 yet. So that's only using 34% of their lifetime exemption. People are going to choose and shop around for how they use those exemptions in ways that give them the most bang for their buck, okay? All right, if the trust earns 6.25, the heirs are going to receive $8 million at a cost in quotes of the $3.6 million exemption. So they use $3.6 million in their exemption, and the family gets $8 million in 10 years, and they made a $5 million gift. Is that a major gift? Is that a principal gift? Is it a planned gift? Is it a leadership gift? What is it? Well, again, the reason a lot of those don't get done is because of language and organizational structures that are set up in ways that you can't get that done, because the people dealing with the donors who need to do that don't know how to do it, and the people who know how to do it aren't allowed to talk to the donors that need to do it, because that's a major donor. Okay. All right, so the gift tax exemption grows at a rate of 8. Let's say that the exemption grows at in order for the $3.6 million exemption to be worth $8 million, that's an 8.3% internal growth on the $3.6 million. In other words, you would have to have the $3.6 million would have to earn 8.3% for 10 years for it to grow to $8 million. All right? Now, the trust only has to earn 6.25 to preserve the $8 million. Okay? So, the donors are getting a very nice return, quote unquote, on that exemption amount, while they don't have to, while from your perspective, the family's perspective, they only have to earn 6.25. Now that's a complicated concept, but I guarantee you that a lot of money managers and trustees, if they get that idea in their minds, they see a lot of money to manage for 10 years. All right, they complete a $5 million gift over a 10-year period. It becomes a lead gift to the capital campaign. Is a lead trust really just an extended pledge? You know, that's all it really is. It's a collateralized pledge. Which would you rather have, that gift there or a $5 million bequest commitment from a 65-year-old? I'll take the 65-year-old bequest commitment, but I'd rather have that. The present value of the bequest at a 6.25% discount rate is $1.5 million. If you're discounting your bequest to present value, that's what you count, 1.25. The present value of the lead trust payments is $3.6 million, exactly the same as the amount of the exemption they're using, okay? Because you present value it, so that gift is worth twice as much. And it helps, this is something, going back to the beginning, this is something that helps rebuild current individual giving levels, while also, I don't care what you call it, you know, call it whatever you want, but it's a good gift. Now, anybody know what this is? These are men right here. I just thought I'd throw this in for just some difference. This is a particle accelerator, a nuclear accelerator. Okay, that's what a charitable lead trust is. You're just accelerating the bequest. You're speeding it up, okay? It also applies to other split interest gifts like deferred gift annuities, term of years trust can do the same thing. So on the high-end donors, you want to get a bequest commitment. Get it from a 40-year-old. I don't care. But just use that as a starting point and then try to accelerate it some way with something that's better. Bequest donors living longer, that's another trend. That's why we have to accelerate bequests. Planned giving people have always known that people who gave at death lived longer, okay? You can observe this lots of places. I'm going to show you, by the way, at the end, I'm going to give you a place where you can download this whole presentation. It had to be current to today, so I didn't want to do it 2 months in advance. But all this stuff is there, just I hadn't told you. You will be able to get this offline. Okay. All of these, I'm going to show you these charts quickly. These are deceased donors and the age when they died. In almost every case, the red bar is age 80. Most of these people are dying in their 80s and 90s. So don't worry if I'm going too fast, because you're going to be able to see this later, and I'm running out of time. Okay, so this is 8,490 estates that have all been stacked. I stacked a whole bunch of these, and you see a perfect bell curve there, and that top number is 92, and the red bar. So if you're taking on bequest expectancies from 60-year-olds and 65-year-olds, you on today's medical care, you're taking on probably a 25 to 30 year obligation for you and your successors in your role for many, many years. Nothing wrong with that, but you got to have the stewardship on the back end, or you're going to be taken out of a lot of these estates. Wealthier donors live even longer. Lots of studies confirm this. This is something that shows from an analysis of gains in life expectancies. What that big red bar over there shows that all the life expectancy increase in the last 40 years has come from people in the upper half of the income range because of health care and others. This is the top 10 bequest donors in America. All these bequests were multi-million-dollar bequests from the Chronicle of Philanthropy. The average age at death of these people was 95 years old, and only one of them died under the age of 90. Catherine Davis, donor who made the Hudson her cause, dies at 106. She started the charity when she was 100, and she died on Tuesday at her home in Hobie Sound, Florida. She was 106. This is not going to be that unusual. So just move the whole thing over to a reasonable period of cultivation, which may start closer to like 65, 70, 75 years old for the wealthiest people. I think there are people at this conference from Mayo, and no offense but they're the problem. A billionaire sneezes, as we know, and they're on a G5 to Mayo to get it fixed, right? Okay, so not only are there a few, these bequest donors from taxable estates, they're old. This is IRS data. The orange are people who died over age 90. The blue are people who died in their 80s, and more bequests from the wealthy come from people who die in their 90s than everybody who dies under 70 combined. All right, the operative wills are mostly done after age 70. Usually it's a woman who's the second spouse to die. Now these are charts that show that in most cases about 50% of the final wills at least are made by people over the age of 70. This is I'm just showing you a number of these. They're all the same. They don't change. There's 2,900 of them all stacked together. This is activity that's usually the final will is done after age 70 by the second spouse to die, and I would pretty much be willing to bet an awful lot that 80% of final wills are made after age 70. And it's not just my data. I would encourage you to go listen to Dr. Russell James tomorrow, because he's done a lot of studies on this, and it's really interesting. All right, many bequest donors. This is something, I know we're running close to end here, but I want to share a couple of things that are very important. A lot of bequest donors we're finding, they don't even make their first gift at all until after 55, 60 years old. This is a medical center. These are deceased donors, and this is the age they were when they made their first gift, most after age 67. Here's a national health charity. Same thing, the red bar is 70. Half the bequests are being done, and this is age 55 over here. Very rare to find a bequest done, the final one, by anybody much under 70. Here's that environmental charity that I showed you earlier. They don't have a lot of donors over 70, but look at the age of their bequest donors who've died in the last few years. Even there, most of their bequest donors were over 65 when they made the first gift. That's why it's so important to be watching the acquisition rates of your older donors. Now this is the first time I saw this. I was, as John Hayes is here, I was gobsmacked the first time I saw this, as the British say. I couldn't believe what I'm going to show you the first time. The second, third, fourth, and fifth time, I began to see that I had understood something here, or found something that has a lot of relevance to you people, in education especially, but all of you. This is a major university that's had an annual fund since 1949. This is their alumni who gave during their lifetime and they died and left a bequest, having given during their lifetime. This is the age distribution of those donors at the year of their first gift. This is 55 years old here. Most of them made their first gift after age 55. Now here's the second time I saw it. Same thing. Very few of them are people that are making their gifts, starting to give, much under 40 years old. Here's the next time I saw it. Median age 59, average 59. Here's the next time, 60 and 60. I don't know why it is, but I go look at it. Take your last 50 bequests and look at how old they were when they made their first gift. This is going to revolutionize higher education fundraising, because we're going to see that there's another round of acquisition, and they're giving up on the annual fund on these people right at the point where many of them, giving to higher education, as to most charities, is an age onset thing, and the people that they're supporting in their 30s and 40s, their whole lives change, and it's a different group. And what Russell's going to tell you tomorrow is that about half the charities, most of the gifts are made after 75, which we know, but in about half the cases, the next to last will had no charities in it. No charities. So that goes against, it's important. Some of you want to get in younger people's wills because you've got a lifelong relationship, alumni, different things. There's no right or wrong way to do this, but just be careful. You remember I showed you this one earlier? Look at that, age 60. That's when the class participation jumps. And it can only jump there because people who never gave before are starting to give. I don't understand this, but you better go find some people that made their first gift to the annual fund after age 55 and get them to write a letter to everybody else, because people who don't go to church for 20 years, they're afraid to go back. And so you've got to have people to welcome them back to the annual fund or for the first time. Okay, again, we're going to look at a couple other things here. This is 10,000 estates. This is the number of estates that came, the number of years from will to death. About half the bequests in America come from people who make their last will within 4 years of death. Again, go back and look at your own stuff. Focus on donors over 70 if you want to get returns. The first will may be good for campaigns, but it's the last one that's going to count on the income statements. That's where the money comes from. Youngest baby boomer couples have a 22-year life expectancy, okay? There's your baby boomers, anywhere from 22 to 40 years life expectancy. Get those gifts. It's important because they're long-term gifts, but the long-term is going to be the short-term sooner than we think. But in the meantime, we need to worry about the short-term before we worry about the long-term. You need to do both, is what you need to do. According to the IRS, the average length of time for a trust in existence is 15 years. That's the life expectancy of about a 70-year-old or 72 or 3-year-old couple. Oldest baby boomers are just now entering CRT land, okay? I looked at all of the trusts for State Street Bank last year as a study thing for their client group. The most common age at doing a life income trust, a unitrust or annuity trust, is 68 years old, and they die at 84, okay? So most of these are done after age 60. The first baby boomers, the planets are lined up for CRTs in ways they haven't been for a long time. There's lots of supply of donors, 68, lots of appreciated property, low interest rates. If we're not at a time now that looks good for CRTs and pooled income funds. Pooled income funds were everything in the 80s, because if interest rates start going up again, the younger people, you flip them over into pooled income funds and keep the annuities with the older people as long as the rates look attractive, depending on the rate of inflation and other factors. But we're going to see a rebirth of pooled income funds here, and I think Frank, is going to talk about that later this afternoon. All right, lower estate taxes are another reason to accelerate things to a CRT or something else, and there's more certainty for you. All right, a couple of more points here. Multimedia marketing. Traditional mail is going to be important, and Frank's going to touch on some of this afternoon as well later. But what studies have shown is that for baby boomers, at least, most of them are going to be primarily direct mail responsive for the rest of their lives for acquisition. Now, not necessarily for fulfillment. I saw this once recently. It's a phone book, and on the side it says, for all your nursing care needs. They know that older people are still using phone books. So, it's like Barlow, man who works with me. It's like, for years, Barlow's always said, what's the best way to communicate with somebody? The way they want to be communicated with. It's not an either-or thing, but you got to be careful when you use the internet. This came out today, online giving up 14%.
They went to 53 major charities, you know, all the big ones. Many of you are here, right? 325 million in 53. The top 4 of those people had more than $325 million worth of bequest income, and who writes about that? You know, all the attention is on, and that's fine. We have to find alternatives, but we have to be careful that we know, for example, that now half the people over 65 are online, but you've got to be careful because when you get to broadband and high speed, it's different. Only about 20% of people over 75 have high speed. I haven't found a university yet that has email addresses on more than 30% of their alumni over 70. So you deal with those 30%, but you better not ignore the other 70%. Most recently, 77 plus, which is where most of this activity is, 62% of people are offline, and some of the wealthier people and the highest educated are the least likely to be online because they never touched a computer when they worked and they can't type, and neither can their wives. And the most high-end retirement centers in the country, multi-million-dollar entry fees, I've asked these people and they say, you know, they don't do it. They have other people do that. Now, if they're under 75 or so, big other story, but it's that people that we got to deal with for the next 10 years. The people that are making the wills now. You see this one that went down I showed you earlier? They switched totally to online marketing, and it broke the back of a program that had gone from 5 million to 30 million. It only took 3 or 4 years to damage it. Same thing happened on this one. It's not either or. You got to do both. This is the same thing here. Switch to online, but only 15% of their donors had email addresses. How do you market when there's no email? I don't get it. Smartphone ownership, only 18% of people over 65 as of a couple of weeks ago have smartphones or tablets. So younger people do, that's fine. All right, the last trend, income tax incentives, want to end with this. Lots of proposals have been put forth. Nobody knows what's going to happen. Conrad's going to talk about this at lunch on Friday. The administration has proposed a ceiling on the benefits. The Camp proposal, it came out a month or so ago, a few weeks ago, proposes a floor. All right, the Camp proposal is much worse for us. It's tantamount to the elimination of the deduction for most people. Don't ignore this proposal. This is very serious. More work has gone into this proposal than anything since the '86 Act. And the people I was talking to in Washington on Monday, the people that are representing a lot of the lobbying for the charities, they're very concerned about this because this is going to be the starting point for the next round. This is a lot of stuff's been decided. This is the outlines of what's likely to happen. A 2% broadening the base, lowering the rates, okay? A 2% of AGI floor on deductions. The average American gets 3%, so that's effectively eliminating the charitable deduction for 2/3 of people right off the bat. Okay, then the other things that they increase the standard deduction, that's fine, but they get rid of personal exemptions, limits on mortgage, and no deductions for some homeowners, and no state or property tax deductions. A 70-year-old with a couple with a $22,000 standard deduction and no mortgage, and they're not itemizers anymore. Okay, they reduce the 50% of AGI to 40, but they increase stocks from 30 to 40 and make it the same. Same limit for cash and property. Hits those who are retired. The people who mostly have to carry forward their deductions, that's 439,000 people. That's a city the size of Portland, Oregon last year. All right, 80% of them are seniors. This will just hurt seniors more than anybody. People who live in different parts of the country are going to get hit different ways. Your AGI limit, if you make $200,000 in Oklahoma City, you have to make $494,000 in Manhattan. So the Manhattanite who can't deduct any property taxes or anything anymore, they've got a $10,000 AGI limit, and the person in Oklahoma City has a $4,000 limit. So there's a lot of stuff that's confusing about this. All right, the other thing is real estate gifts would be limited to basis, stock, and so would closely held businesses, but stocks would be deductible at full value. You add this all up, only a small number of people would still itemize. Most people would have to make their gifts from after-tax dollars. What does that mean? If you want to give $1,000 and you can't deduct it, and you're in a 25% bracket, you have to earn $1,333 and pay $333 in tax to net the $1,000. Okay, the biggest impact is high income, high tax states, those who make average gifts, seniors as a group. The IRA rollover will be so important because nobody will be itemizing. So not getting the money at all and not reporting it is the same thing as reporting it and fully deducting it. So the IRA rollover is essentially a non-itemizer deduction for seniors, and we need to start thinking about how to really work on that. The typical gift annuity donor, you wouldn't be showing after-tax returns because they're not going to get any tax benefits from it. So it's less relevant. We'll have to go to other motivations that we used 100 years ago. This is a college in 1910, no income tax, no estate tax. They focused on intent, and they had the bequest language on the right, and then they had their annuity language. Whoever wants to support the annuity plan with a larger gift should apply to the president. In this donor plan, the donor gets the interest on his gift as long as he lives. A good plan for those who need the interest to support themselves. You see, the motivation was the same as it is now. It's people that want to make a gift in their estate, but they want something better. Other things, the good news is that charitable remainder trusts, lead trusts, none of those are touched by the Camp proposal, and it would continue to be a lot of attractive to the higher end taxpayers. All right, so you want to continue to communicate the tax benefits. You want to keep them in perspective. They may or may not be permanent. In the meantime, we want to help people make tax-wise gifts. Now I want to stop here for a second, and I'm going to end this, but Friday afternoon, I was supposed to, initially was asked to introduce Conrad Teitel at the luncheon meeting, and I had something that I had to leave. But I want to say, because I want to get a chance to say that, most of you will be there Friday when you see that. I've been reading Tax-Wise Giving since I was 16 years old. But I didn't read comic books. I read Tax-Wise Giving, right? Claudine, you probably read a few of them yourself too, right? Okay, so the point is, this man is a giant and has been a source of the right way to use tax incentives and protect them for a long time, and he's done a lot to preserve the legitimate and fight the illegitimate over the years. And I learned a lot of things from him about the right way to use tax benefits and communicate them and the wrong way to do it. So I just want to just add to the introduction that Louis von Herman of our staff is going to do on Friday, but I just want to again make it clear that he has just been a very powerful influence in this field. All right, the wisdom from Yogi Berra I'll leave you with, okay? It's deja vu all over again, right? Things change all the time. Here's some wisdom from your childhood. You know what this is? It's a kaleidoscope, and it's got a certain amount of stuff inside it, and it never changes what's inside it, right? But you turn the kaleidoscope one way and you see one thing, and you turn it another way and you see something else. That's the best example I can give you of how this works. All these factors are always there all the time, but you turn it just a little bit. You change the tax rate here, you do this, or the age expectancy, whatever, it all changes just a little bit, but the whole picture changes, okay? That's what makes this field so fun and challenging. And again, many of you have seen the quote from Aristotle that, it's really hard to decide whom to give to, how much, in what way, for the right reason, et cetera, et cetera. But it's difficult, but for only a few people can do it, but it's praiseworthy and noble. I think what we do is praiseworthy and noble. It really is. And I think it's not easy, it's not, but it's something that's worth the time to keep picking up the kaleidoscope, look at it, see what you see. It may be different tomorrow than it was yesterday. I probably won't be here in 30 years when people are dealing with the same stuff, but some of you will be, I hope. So it's not the world. Human motivations, basic stuff doesn't change. The bottom line factors are all the same. They're just being rearranged in different ways at different times. Okay, I'm going to, up here, if you want a copy of this, just go to our website and you can download it. And I think that a video of this may be available from ACGA in sometime. Anyway, enjoy the rest of the conference. I appreciate your time this afternoon.